Hello to everyone. I'm going to make this tutorial. It's on leverage buyouts. I know you've requested it. Looking back at my videos, they're more or less live modeling. They're not really tutorials. So I decided to make this one here, which is we're going to start very easy, basic LBO. I will put this template or this exercise also on my GitHub, so I'll put it in the link in the description below. You can use it, you can follow while I'm doing it. I think it's important to have this tutorial because I'll go through what an LBO is, what are the different sections, how to fill each part of the LBO model. You'll see that even if we go towards a more of a complex model, usually the sections are always the same, so it's not too complex. Okay, so what is an LBO? An LBO is a leverage buyout. It's an operation that a private equity firm goes through when they acquire a company. And an LBO model is basically trying to understand what are the returns if that investment is worthwhile. Okay, so you have different sections here, and the end result of an LBO model is going to be an IRR and a multiple on invested capital, multiple on cash, multiple on money. It's the same it's the same thing basically. So an IRR is a percentage, a multiple is 2 times, 3 times the money that you injected at the beginning of the transaction. Okay, those are the two main KPIs or the metrics that we want to measure with an LBO model. This time we're going to start very easy. We are going to say that I don't know. Let's see, 2000. We're going to invest in 2025. We're going to keep the company for a period of 5 years, so from 2026 to 2030. And at exit, when we are exiting the company, so in 2030, we want to measure what is the IRR and the multiple on cash. Okay. We have different sections when we go through an LBO models. We have the assumptions tab, then we have the income statement here. Actually, we also have this section here. Let me add it. Let's do things the proper way. This is sources and uses. Okay, then we have the income statement. Then we have the cash flow statement. Then we have the cash and debt schedule. Then we have the cash schedule and debt schedule within the same section, trying to understand how we are going to repay the different debts. And then we have the last section, which is the return calculation. Okay, these are the main parts of an LBO model. They're always the same. If you're doing something slightly more complex, you might also have the balance sheet with the pro forma balance sheet to create. But other than that, I would say the main components are always the same. Now, I did this, as you see, the sections are already there. I'm not going to build them from scratch like I've done in other videos. That's not the main intent. The main intent is to go through each section with you and try to explain every part in detail. So what we're going to fill out are the pink ones, the pink areas. Everything else you see that is already filled out because those are basically the inputs. Now, when we start with an LBO model, we have to start with the assumptions tab. And we have to try to understand what are the transaction assumptions, what are the entry and exit assumptions, and also what is the capital structure that we're using to finance this investment, right? In this case, we're talking about the debt assumptions. Now, let's go section by section. The first thing that we want to do in an LBO model is try to understand what is the purchase price of the company. So in this, usually the main way to do this is you start by the EBITDA of the company, so the last 12 months LTM EBITDA. You multiply it by a multiple. In this case, we are assuming it's going to be 8 times the EBITDA, and that is going to give us the purchase enterprise value. Usually, what's important to know is that if we are doing something that is not cash-free, debt-free, that means that the seller is not going to retain the excess cash and repay the debt. So that cash is going to be passed on, the debt is going to be passed on to us. Then in that case, we would have to add other parts here, which is going to be, you're going to add the debt, the cash, you're going to less the debt, and that's going to give us the equity value. Okay, and that's going to give us the actual price that you're paying for the company. Since we are not dealing with a non-cash free debt-free basis, we're going to say that the cash is retained by the seller is going to pay the debt off, and so for us we don't have to deal with this component. Okay, so the purchase enterprise value is already going to be the acquisition price of the company. Of course, we also have an assumption at exit, so that means that after 5 years that we have held the company for, we're going to sell it. At what multiple? We are going to assume that it's going to be equal to the multiple of EBITDA at entry, 8. Okay, transaction assumptions, these are things that are already given. Okay, it's not something that you have to calculate. I mean, transaction fees are 10 million. Financing fees is a fee that you pay on the tranches of debt. That's going to be 2%, and you're going to amortize that for 7 years. Minimum cash to balance sheet is a concept which is super important to know. That means that we cannot go really below $5 million dollars in cash, because that 5 million is the minimum amount of cash needed for the business to operate. Okay, and that's important to know. So that's the definition. Now we have the debt assumptions, and here we're saying that we have 3 tranches of debt that we're going to use to finance this acquisition. One is going to be a revolver. A revolver is like a credit card, meaning that if, let's say, your cash, your free cash flow, whatever, is below 0, like minus 10, you can use the revolver as a credit facility. So you're going to draw from the revolver 10 million and use that to repay the debt. Okay. The year after, if the cash, what you generate, is greater than 0, you're going to use that greater than 0 value to repay the revolver. Okay, we'll see that after. Term loan B, senior notes, those are tranches of debts, and for each tranche of debt you have what is the multiple of the EBITDA to calculate the amount. The rate is basically the interest rate that you're paying, and then you have a floor, and you'll see this in a second. Then we have amortization fee, which is a mandatory payment that must be done for the debt. And then you have, of course, the financing fees, which is related to that 2%. Before going into sources and uses, let's start filling out this stuff here. So whenever you have EBITDA and ex-EBITDA, you're going to multiply the 2 to get the enterprise value. Okay. Revolver amount is 0, so it's 0 times the last 12 months EBITDA. So you're going to get that, and this is the value of the total debt. Then financing fees, in this case, well, it's always 2%, so we can do this. That's going to be 2%, and we're going to multiply it by the amount. Okay. So we have 11 million in financing fees to pay. Now, let's look at this section here. This is the LIBOR curve. Now, LIBOR curve is like a reference rate on top of which you put a spread. So you're going to say that the revolver is going to have an interest rate, which is the LIBOR curve, plus you're adding 350. Now, 350... to get the percentage is basically 3.5%. Okay, so if it's 400, it's 4%. If it's 500, it's 5%. Okay, so on top of that, this is the spread, and then you're adding it on top of the LIBOR curve. Now, the fact that you have a floor rate, okay, means that basically what you're saying here is that the actual rate as a starting point is going to be the max between the 2% and the LIBOR curve. The LIBOR curve is something you can find online. So if LIBOR curve is below 2%, the actual rate that you're going to use is 2%. As soon as it becomes greater than 2%, 2.1, it's 2.1, 2.3, 2.3, okay, and not 2%. Now, we will use that later, so I'm going to show you how we apply the interest rate in a later stage, not now. Now let's look at the sources and uses. Sources and uses is the second most important section of an LBO. And it's basically telling us how we're going to use the money and where are we going to draw the money from. We usually start from uses. So the money that we have is going to be used to, of course, buy the company, so the purchase enterprise value. One use is going to be to keep that minimum amount of cash in the balance sheet of 5 million. We're going to use the money to pay the transaction fees and pay for the financing fees. Okay, so these are the uses. Pretty logical, I would say. Ex-EBITDA, it's going to be, well, let's start with the amount, it's easier. This is going to be 800, then we're going to have cash to balance sheet is 5, transaction fees is 10, and then financing fees is 11, okay. Sum them all up, and that's going to be this divided by the purchase enterprise value, so that's that, and that's let's see, custom, there it is, okay. And the same thing we're going to do it here. Revolver is, the amount is 0, senior notes. Now what I'm doing here, sponsor equity is something that we need to find. To find the sponsor equity is simple. The sources have to be equal to the uses. Usually you start with uses, then you calculate the sources. So 126 of uses has to be equal to the same amount of money that we have. Okay, what comes in comes out. Okay, that's the basic logic. Sponsor equity is basically the money that you need to inject, and it's something that you do like in a reverse engineered way, because basically you know how much are the sources, you know how much are the tranches of debt, what is the amount of money that you need to add yourself to get to the same amount of sources. So you go here, sum, you go here, sorry, you do this minus the sum of this, 276, okay. That's the amount of injected value. So to do this, still the same. And there we have it, okay. Okay, so we finished the sources and uses. Now we have to do the income statement. Now the income statement is extremely important, and that's where all of the assumptions come into place, because to build the income statement, you need to have hypotheses on how the revenue is going to grow, if the EBITDA margin is going to be flat or if it's going to grow, what is the depreciation amortization as a percentage of revenue or whatever. And to do this, you usually have this section here, which is operating assumptions. The operating assumptions is, how much is the revenue going to grow year on year? How much is the EBITDA margin going to grow year on year? Made a mistake, it's 10. D&A as a percentage of revenue is going to be 2% flat. CapEx as a percentage of revenue is 1.5. Change in net working capital is 1.5, and then the tax rate of 30%. Okay. So we're going to use these operating assumptions to build out our income statement. So basically we're saying this times 1 plus the growth rate, 8%. Then we have EBITDA is going to be this times the margin, which is constant 10%. Then we have less depreciation amortization. It's going to be as a percentage of revenue, this times -1, sum of the two. And then less interest. We are not going to build this now. We're going to keep it there because the interest is something that you calculate at the end once you've understood how much is the debt amount that you have year on year. Amortization of financing fees is basically, you go up here. Remember that we have financing fees, which is 11 million in total, but this, remember that it has to be divided by 7 years, because that's the oops, I didn't block it. What I was saying before is that the financing fees is something that you amortize. So if you have 11 million in total over the period of 5 years, and the total actual period of the financing fees is 7 years, you're basically getting the 11 million and you're dividing it by 7. Okay, that gives you the amount of financing fees that you have every year. Okay, taxes, that's going to be this times 30%. Oops, has to be negative sign. Always remember the negative sign. Okay, and there we have it. So this is the income statement. Now the cash flow statement. The cash flow statement is always built in the same way. So you start with net income, you add back all of the non-cash expenses, in this case depreciation, amortization, but also the amortization on financing fees. Then you deduct the capex, and then you deduct the increase in net working capital. Okay, so you start with this. You add back depreciation, amortization. You add back the amortization of financing fees. Then you deduct the capex, which is going to be revenue. Capex, which is this one here. Then you're also getting this. There it is. Is it the same percentage? Exactly the same. 1.5, 1.5. Okay, it's the same. Okay, that makes sense. Let's do a bit of formatting here. Oops. Okay, there we have it. Now we have the free cash flow. Now, why is it important to build the cash flow statement? Because whenever you calculate returns, you have to try to understand so you've generated X amount of cash. After you deduct all of the other expenses, like you repay off the debt, you repay the investors, whatever, how much cash do you have available? And from that, you can start thinking of the returns. You have to, that's the main point of this LBO, no? It's important to look at the cash flow statement, because then you say, okay, 5 million of cash is the minimum amount of cash that is needed to operate the business. How much other cash do I have that's working in the business? How am I going to use that cash to repay off the debt? And then we can calculate the return. So this is an important part of the LBO model. Okay, so this should be correct. If I'm making mistakes, let me know, but for now I don't see many. Okay, free cash flow. Now we have to do the third section, which is very important. Third or fourth section, cash and debt schedule. This is what I was just saying. No, so you know that you've generated this amount of free cash flow in the business. Now we have to try to understand how much cash I'm going to be left with after I repay the debt, after I repay mandatory payments, after I repay optional repayments of the debt, and how much am I going to be left with? This is going to be the end line of the cash schedule. And you will see that I will go back and forth between cash and debt schedule, because the amount of money I will be left with is going to be strictly dependent on also how am I going to pay the debt tranches. So as you can see, I will have balances for the term loan B, for the senior notes, and for the revolver. So I'm going to be going up and down between these two sections. So free cash flow, get it from there. Now, less mandatory repayments. This is something that I cannot put now. I cannot plug in now because it's going to be something that I will find in the debt schedule. But in any case, after I have this, simply I'm going to be summing these two. And this is the amount of money that I have after I've paid my mandatory amortization. Now, cash drawn from the revolver is basically important to know, because as I was saying before, if this 50 is negative, I'm going to go to the revolver facility and get that amount of cash that I need to repay my debt. Okay, so after I have that, I will do exactly the same thing. I'm summing them all up. Then with the amount of cash, if I have any left, I could do also some optional repayments. I've included this line even though in this exercise we are not going to do optional repayments. If you're interested in that, you will see also in my other videos that I usually do optional repayments, but it's basically another line to add, but nothing complex to do. Once that is done, this is the amount of cash, net change in cash. Let's fill in also this formula here, because what's important to understand is that this is a change in cash. This is not the actual amount of cash that I have left each year in my balance sheet. So what I do here is that I already know in my balance sheet, once I've acquired the company has kept that $5 million of cash, which is the minimum needed to keep the business working. So that is going to be my starting point. So if I start with 5, then I add this amount of cash, sum the two, and next year I'm going to have 55. And I can drag these formulas across. Okay? Of course, don't worry now, the numbers are huge, simply because we haven't deducted the amortization, we haven't done anything to this. Now, let's leave that aside and let's go to the debt schedule and try to build up this stuff. So beginning balance here is actually 0 because the revolver, we're starting with nothing right now. And let's build these formulas here and I will explain it in a minute. My suggestion is whenever you do the revolver, just learn the formula that I'm going to show you by heart. So let me explain what this is. Okay, so basically the beginning balance is 0, meaning that we're starting that we haven't drawn money from the revolver, okay, from the credit card. So that's 0, that's the starting point. Now revolver drawn or pay down is basically this formula here. Mean, and this, bear with me, I'm going to explain it because every time I get it wrong. I haven't done this in a while, but it should be mean between this and the cash pre-revolver, which is this, this mean should be this. Let's see if this works. So let's see if this works. If I'm negative here, yeah, okay, it's working. So what's happening here is simple. So what's happening here is quite simple. Basically, if you go negative 20, you're going to draw from the credit card $20 million, okay? What is the ending balance of the revolver? 20. This ending balance is basically the money that you will have to pay down the year after, okay? So you draw money of 20, and the year after, since you're going positive of 54, so not negative, you're going to use the 20 million of this 54 to pay down the revolver. And so the balance is back to 0, okay? That's it. This total revolver capacity is an important line to know, which is 50 is the max that you can pay, you can draw from the revolver. You cannot go beyond 50. And this is also why you have in the formula, the external min is saying you're going to pay down or draw the minimum between the total revolver capacity and the actual money you have to pay that you have. Okay, that meaning that you cannot draw, if you're negative 80, you cannot draw 80 from the revolver because the max capacity is 50. Okay, remember this formula by heart. It's much easier. You can do it in many ways. You can also do an if for you it's easier to understand. But this minimum formula is something that is widely used in every LBO model. So my suggestion is do it like this and it's easier. Okay. Now, interest rates, this is something that we're going to look at after. We don't care about this because I also want to show you another formula for the interest rates. For now, let's keep it like this. So, okay, this we can already plug it in from here. So cash pre-revolver is 50, cash drawn from revolver is 0 in this case, and 0 all the line. Let's look at the term loan balance, the term loan B. So the beginning balance of the term loan B is 250. Less mandatory amortization is going to be, we have it here, is that 5% times this amount here, and times -1, because remember that it's a payment that we have to do. And there you go, that's the term loan B. Now remember, always remember, let me fix up the format. Now always remember that since we're not talking about optional repayments, in this case you only see one line which is less the mandatory amortization. If you also had the possibility to say, okay, I'm going to also use the excess cash to do optional repayments. You would have another line which is less optional payments, and you would fill in this line with an extra amount of cash that you're going to use to pay down the excess amount of debt that's outstanding. Okay, but we don't want to make it too complex, even though it's just one extra line and nothing complex really. Senior notes is, we're doing exactly the same thing. So senior notes, we go here. I don't think, let me check. Do we have mandatory amortization for the senior notes? We don't. So in this case, we keep it simple. What did I do wrong? Okay. And there we go. Now, let's go here. Remember, less mandatory amortization. It's going to be this plus the mandatory amortization for the senior notes, which is 0. And there we have it. Optional repayments in this case is 0. And okay, seems to make sense. Now let's build the interest rates. Okay, so for the revolver we have two things. One is the interest rate and one is the commitment fee. Now, unused commitment fee compared to interest rate is slightly different. The unused commitment fee means that if you have the revolver which has a capacity of 50 million and the ending available capacity of every year is still 50, meaning that you haven't used the revolver in any way, you're going to pay at 0.25% on top of it. Okay, it's a fee that you're using, that you're paying for not having used the money of the revolver. That's it. The interest rate instead is something that is like the term loan B, is like a debt, is like whatever. You have the interest rates that you have to pay on top of the amounts every year. That's it. Now we have to do something here. So the interest rate, first of all, let's calculate what is the percentage of the interest rate. And to do this, remember that for the revolver is this, okay, which is divided by 10,000 because it's 3.50%, but consider that this is 350, so we have to divide it by 10,000 to get the actual percentage, plus the max, okay, which is the LIBOR plus the spread we're adding here. So that's 5.5, and I think it's this. Okay, yeah, that makes sense. So the interest expense. Now bear with me on this formula. I'm going to explain it. If circ okay, let's do it like this, equals to 1, then we're going to get this multiplied by the average between this and this, otherwise 0. Now what am I doing here? This is important to know. Now the circ that you've seen before, that you just saw here, this circ equals 1, is basically this. Where is it? This circ here. This is 1 or this is 0. It's basically telling me, it's something very technical for Excel. It's nothing to do with LBO finance in general. Basically this is let's say an escamotage or whatever you want to call it, that is being used in Excel in case you mess up a formula, you remove a row in Excel. You know, when you basically fuck up in Excel, you delete a line and everything comes out with ref, div 0, all of those strange errors. Okay. In this case, since you will find the circularity, and I'll explain it very soon, not necessarily now, but so that you get just a general idea of what this circ is and why it is important to put it. If you just do Command Z to go back, once you fuck up and there is a circularity in Excel, Excel won't restore the numbers. Okay, it's basically fucked up forever. But if you have this circularity toggle and you just go back to 0, which means that you're not calculating the interests, okay, everything will magically fix up again. Okay, so just keep in mind that this is why we have this circularity toggle. It's nothing to do with LBOs, but you have to put it, otherwise you will mess up. commitment fee, this is 0.25 every year, and we're going to do the same thing. So if circ equals 1, then we're going to do this, multiply by the average of this and this, otherwise you put 0. Okay, see, 0.1%. If let me show you this. If I do this, okay, this is fucked up, no? No, it didn't work. Let me do something else. Let me try doing this. Did I put circularity toggle equal 1? I think I did. I don't know why. Okay, no, it's not fucking up. But if it fucks up, I'll show you how to use that circularity toggle. I don't know why it's not working. So now it seems to be working fine. Let me fix up a bit of the formatting. Now, let's do exactly the same thing here. So for term loan B, remember we have to go up here. Term loan B has still 350 divided by 10,000 plus we're adding this. Here we're going to lock it. Same exact thing. Interest expense is going to be if circ equals 1. Then we're going to do this, multiply by the average of beginning and ending balance. Otherwise, just put 0 and that's it. We're going to do the exact same thing here. And for senior notes, it's easier because the rate is already 8.5%. And we're going to do if equals to 1, then we are actually going to calculate it as this multiplied by the average between the beginning and the ending balance. Otherwise, just put 0. And there we have it. So we have the interest expense. Okay, so a little bit of formatting here. Now, before calculating the returns, remember that we still have some things missing up here, right? So remember that we had left aside the interests here, but we have to just do this. So this is going to be the sum of this plus this plus this plus this. Oops, and it's okay, there we go. Okay, we plugged it in, and now we can calculate the returns. Now, to do the returns, how do we do this? Now, the way is quite simple of doing this. It's not too complex. So exit LTM at EBITDA. So we can do this for every year, basically. And I'll show you what happens. So we're going to get the EBITDAs of every year. We go up here, we get this is EBITDA. Now the exit multiple assumptions, we can say that whatever exit year we have, the exit multiple is going to be 8. And then this is going to be product of these two. Okay. Now this time we have to get to the equity value, not enterprise value, because this time we also have the debt and the cash to consider. So we're going to remove the debt, which is going to be basically this minus this minus this. Okay, so it's the revolver minus it's the ending balance of the revolver plus the ending balance of the term loan B plus the ending balance of the senior notes. That's the debt. The cash is going to be positive, and the cash we go up top, and we're getting this. Okay, sum of this, and we get the equity value. Okay, now let's start with the multiple on cash. Usually I start with the multiple on cash and then the IRR. Basically, the multiple on cash is how much we've generated at the end of each year divided by what was the actual equity value that you injected at the end, which is 276, the one that we calculated before. Okay, so as you can see, the return, the multiples go up now every year that passes. To do this, you do the IRR is this formula, so it's basically the multiple on cash multiply elevated to the power of 1 divided by basically this minus this. Let me just fix this formula up, and then minus 1. Okay, so that's the formula that we're using. So once we have this, and we are exiting, we're considering exiting at 2030. In 2030, you're basically going to have 3 times more or less the equity injected at the beginning, which is very good, and more or less a 24% IRR. Okay, so this is, let's see if we haven't forgotten anything. Let me try to see. So it seems well done now. I mean, I don't think we've made any particular mistakes. If I try to do this, let's see if it fucks up in any way. I want to show you how the circularity toggle works. Okay, yes. So, okay, what you just saw now is basically a fuck up of Excel. I already did Control Z or Command Z, and as you can see, the refs are still there. Okay, so we go up here, circularity toggle, put 0. Okay, and now everything has been restored. Now I can go back here and put circularity equals 1, and everything is restored again, included the interest rates. Okay, so that's what I wanted to show you. Now, guys, I hope this has been useful, and this will be useful. This is the end of the tutorial. Let me see if I didn't fuck up with the values. 23.9%, 2.9%. Okay, so that makes sense. So I will upload this file, and it's got both the template, so to fill and also complete. And yeah, hopefully you'll find it useful. And that's it. If you have any comments or questions, ask me in the descriptions. In the comments below. I'll try to answer them all. And hopefully, yes, you will get something useful from this video. Bye, guys.